Well, hello there, and thank you for joining us for the review session for exam 2. We are just going to quickly go through each one of the exercises that's in the practice set. Remember to find this in Cengage. See now, you need to go to either the assignments I can practice now or the all assignments tab. You won't find the practice set in the assignments I can take now, which is the default, because it's not graded. So you'll have to find this set in one of those other tabs. Also keep in mind that because many of these exercises are generated algorithmically, and you can see which ones those are, it has the .algo here at the end of the number for the exercise. Because they're generated algorithmically, the exercises I'm showing are exactly the same exercises, except they may have different numbers than what you have in yours. So the process, the equations, the calculations that I talk about and show will work for yours, but you'll need to use the numbers that are in your exercise, not the ones that are in mine if they are different. Now, these first three should not be different because it doesn't have the algorithmic tag on there. So let's get started. Our first exercise, remember this exam is on chapters 4, 5, and 6. So you can see with the numbering which exercises come from each chapter. So that's the same thing is true on the exam. So if you are stuck on something, you're thinking, I know how to do this, but I just can't, I need a hint. I need to look in the book. You can see where to at least get started by looking at which chapter did this content come from. So the first exercise from chapter 4 is related to closing entries. This textbook uses a two-step closing process. The first step is to close all of the revenue and expense accounts, and they close those directly into the retained earnings account. So they're adding the net income or subtracting the net loss. So as we look at our accounts here, we can see starting here, revenues and then 4 expense accounts. To close the account, you need to basically zero it out. And so when the revenue, for example, we know revenues have a normal credit balance. So to zero out that account, we would need to debit fees earned. And we would debit it for the full amount that's in there. In this case, $975,000. Remember, in a journal entry, all the debited accounts need to be listed first and then the credited accounts. All 4 of these expenses as temporary accounts also need to be closed. Temporary or nominal is the other term that you'll hear for those type of accounts, the income statement accounts. And expenses all have debit balances. And so to close those, we're going to need to credit. And each one needs to be credited separately to zero it out or to close it. So we don't have just one entry. Whoops, I put an extra 0 there. We don't have just one entry that says expenses. We have to close each expense account individually. And again, we close it by when it has a debit balance, we need to credit that account. If it has a credit balance, we need to debit that account for exactly the amount that's in there. And so once we post this entry, then all of these temporary accounts, income statement accounts, will have a 0 balance. And that's why they don't show up on the post-closing trial balance. And then we are ready to start the next period. So the entries that we put in, say on July 1st, because this is closing at the end of June, the entry for July 1st, if it was a revenue or expense, it would be starting from 0. And that's how it should be for those temporary accounts. So now I need to I have all of my revenue and my 4 expenses. But remember, every journal entry has to have equal dollars debited and credited. This is a compound entry because there are a bunch of credited accounts here. And I just don't know how much the total of these 4 expenses is. So I'm going to add those up quickly here. And that's $744,000 in expenses, because that's less than the $975,000 we had in revenues. We know that this company would have a positive net income for this period, and that net income would be added to or credited to our retained earnings. So let's see exactly how much they made. We take the revenues of 975,000 and subtract the total expenses of 744,000. Their income would be 231,000. Again, we're crediting or adding that to retained earnings. So this is the one-step approach to closing the income or the income statement accounts, the revenues and expenses. As I said in class when we covered this, some companies use a three-step approach where they close the revenues separately to a separate account called income summary. They close the expenses all to an income summary, and then they close that income summary to retained earnings. This is a much more efficient approach to do it all in one step, but you may see it in that three-step fashion for some companies. The second entry here, which says journalize the two entries, the second entry is to close the other type, the other type of temporary or nominal account, and that is dividends. So dividends is closed separately because it is not part of our income, doesn't show up on the income statement, it's not an expense. But dividends do have a debit balance, and so to close that dividends account, we would need to credit dividend, dividends, $30,000. And just like the income statement accounts, the dividends do get credited, closed to the retained earnings account. And so dividends reduce retained earnings. Those represent earnings that we did not retain, that we paid out to our shareholders. We'll talk more about dividends and dividend policy when we get to chapter 12 on stockholders' equity. So just like in our last review session, if you do have any questions, you're welcome to unmute and ask your questions or post something in the chat. But if I don't hear any questions, I'll assume everybody's good, and I will just keep going in the interest of being efficient with the time that we have. So let's move on to our second exercise, and I'm going to collapse that on the side just so that this can appear full screen. This is the end of the period spreadsheet. Now, we did not prepare any of these, but we did see this. We did talk about what would be included here. Preparing these spreadsheets was part of the appendix, one of the appendices to this chapter, which you're not responsible for preparing, but you should understand what is here. So the first two columns here, the set of debit and credit columns, is the unadjusted trial balance. The next two columns include the adjustments, so you should be able to match up the debit like here to the credit. So each one of these is going to match up so you can see what those entries were. And then the final set of columns is the adjusted trial balance, and those are the amounts that we would use to prepare the financial statements. And that's what we're asked to do. Based on the preceding spreadsheet, prepare an income statement for Paoli Consulting. And so the columns we would want to use are these two on the far right. And of course, we're doing an income statement, which means we're using the ending accounts, the final accounts on this trial balance. The chart of accounts is always listed in the same order: assets, liabilities, permanent equity, dividends, revenues, and expenses. If we were to look at this, you can see that. So we have cash, accounts receivable, supplies, land, building, accumulated depreciation. All of those are asset-related accounts. Then we have the liabilities accounts payable, salaries payable. We have the permanent equity accounts, common stock and retained earnings. Then we have dividends. And so the revenues and expenses, the information we need for to prepare an income statement, those are always going to be the final accounts on the trial balance. The expenses are going to be last, and then the revenues will be the first credit balance account going up from the bottom. So again, we can see that our revenues are that fees earned, 1,675,000, and we have 4 expenses. Now, our general rule will be to put the expenses in decreasing order, decreasing size order. They already have them arranged like that for us here. Salaries is the largest, so it's going to go first, and we go down from there. The exception is miscellaneous expense, and since that usually includes a bunch of different things that are really all kind of small individually, we don't have to put that even though it's 15,000, so it's more than the depreciation expense, we would not put it above depreciation expense because it is a compilation or a whole bunch of different small expenses that don't have their own individual accounts, but they're all thrown together in that miscellaneous. So we always put miscellaneous last. Whoops. Got an extra 0 in there too. I'm going crazy with my zeros today. Of course, the next step is going to be to add together our expenses so we can list a total expense amount there. Because the software does it for us, I want to remind you of the placement of our dollar sign. So we always have a dollar sign at the top of the column, and then we don't need another dollar sign until we're taking a total. So if it's underneath this bar right here, we need another dollar sign. But the total expenses would not get a dollar sign because this one kind of carries down. Finally, because the revenues exceed the expenses, that would be a positive net income. And that net income would be $665,000. We have a double accounting underline under the grand total. That tells us that we are done. There isn't going to be any more information after that. Once we prepare the income statement, our second financial statement is always going to be the statement of stockholders' equity. And this shows us what happened throughout the period. So we start with the beginning balances that will come from just want to make sure it doesn't tell us that any stock was sold. That's it. Right here. Okay, so it tells us that during the year, $15,000 of additional common stock was issued. So this beginning balance here for common stock isn't really the beginning of the year balance. That's the balance just before adjustments. So if we had sold 15,000 during the year, our beginning of the year balance would be 100,000 minus 15,000. It would be $85,000. And our retained earnings, now nothing has happened to this retained earnings because we haven't yet added the income to it. So the $1,860,000 that you see there for retained earnings would be our beginning balance here. And then we can add across to get the total equity at the beginning of the year. These amounts would have appeared at the end of last year on the balance sheet. And what we're calculating here is how much would appear on our balance sheet at the end of this year, so March 31st, 2019. We saw that we were issued common stock. It does tell us if the amount box doesn't need an entry, we can leave it blank. So we don't need to put a 0 in the retained earnings column. Selling new stock, or what just happened? Issuing new stock does not affect retained earnings. So I'm just carrying that total across. We did earn some money. How much money did we earn? Well, we just calculated that here on the income statement. And as we talked about in the first exercise, when we calculate that income, we then add it to retained earnings. Making money doesn't affect our common stock, and so we're leaving that entry blank. And the final piece is dividends. And it does tell us here that we paid $30,000 in dividends. And as we saw in the previous exercise, when we closed that dividends account, we subtracted it from retained earnings, and that's what we're going to do here as well. So I do need to show that as a negative because, as it says here, because it reduces our retained earnings, we want to show it as a negative using the minus sign. So now it's just a matter of adding down the columns to find our balances for the end of this year. So for retained earnings, our starting balance plus the net income minus the dividends. And then we can add across and we can add down. And that gives us a way of checking ourselves. Of course, if you're doing this at home, you can use the check my work button as well to make sure that adding across and adding down gives you that same total. And so now we have the balances to move forward to our balance sheet, which is the final of the 3 financial statements that we are preparing for now. We know there's a fourth, the cash flow statement, but we are not going to be covering that until we get to chapter 13, very much at the end of the semester. So we know until we get to chapter 12, we know the only 2 stockholders' equity accounts that we are using are common stock and retained earnings. And we just found their ending balances right here, 100,000 for common stock, 2495 for retained earnings. So we might as well go ahead and enter those now. And we can total those. We already know the total from the statement of stockholders' equity. Putting those in now might save us a little bit of heartache later, because it's really easy when you are creating the balance sheet from a trial balance to just start going down the list, entering, and then, oh, guess what? We get to the retained earnings account, and the amount that's on this adjusted trial balance for the retained earnings isn't the ending balance, because it still includes the dividends and it doesn't yet include the income. So it is probably good practice when you're doing this by hand, as we are, to make sure that you enter those balances from the statement of stockholders' equity right away. Now we're doing in chapter 4, what was new to our balance sheet was the idea of the classified balance sheet, where we separate our assets into current assets, property, plant, and equipment. I've mentioned some other categories you might see on some companies' balance sheets, including things like intangible assets, investments, special assets, or miscellaneous assets that don't fit into the other categories. For us, for now, though, we're just using the 2 categories: current assets, those things we're going to use up or turn into cash within 1 year, and then the long-term assets, the property, plant, and equipment. So our current assets include cash, accounts receivable, and supplies. Apologize, I'm going to have to do a little bit of scrolling up and down because I do not have printouts of these, and I don't want to trust myself to remember the numbers when I get down. So I'll just have to keep scrolling up and down. It's tough to get old. Can't trust your memory. And those are our current assets. So I'm going to go ahead and stick in a total for those. $472,000. Again, you'll notice dollar signs at the top of each column, and not again until you have a subtotal bar. Next, we have our long-term assets. So remember, we talked about briefly in chapter 3 that land is not subject to depreciation, but all of the other long-term assets, building, equipment, and so on, all of those are subject to depreciation. So the land is going to be standalone with a value of $1.4 million. And then the building is a depreciable asset, and so it's always going to have its original or historical cost and the amount we have used up or recorded as depreciation expense during the time that we've been using that asset. So we need both of those numbers. The building had an original or historical cost of $850,000. And after this year's depreciation, we have a total accumulated depreciation of $72,000 that has a credit balance because it is a contra asset. It goes against the building. It goes against the asset. And probably show that with a negative to remind you to subtract. Doesn't say we have to use a negative, but it will be maybe helpful for you to remember that that depreciation does reduce the book or carrying value of the building. And so we paid 850,000 for it, but we've already used up or recorded as expense 72,000 of that, leaving just 778 as the book or carrying value of that building. We'll talk more about that when we get to chapter 9, which is all about long-term assets. Now we have all of our assets on the balance sheet, and we can go ahead and put in, whoops. Yeah, that's the total for our property, plant, and equipment. And then we can add to that the total of the current assets. And now we have something to use as a check. When we get down here, our total liabilities and equity must, of course, be the same as that total assets number. So it's a good way of checking ourselves, even when you don't have that check my work button to use. Our final two accounts then are the liabilities, accounts payable and salaries payable. And we definitely want to pull them from over in this far column because the salaries payable represented an adjustment. And so it doesn't appear with a balance here in the first set of columns. So 36.5 and 18.5 for those two. And that was accounts payable, salaries payable. Let's total those. And then add that amount to the total stockholders' equity. And luckily, we did find that our total assets and our total liabilities and equity are the same. And so that's a good sign that we have done this correctly. You'll notice one more thing before we move on, that our liabilities, we only have current liabilities listed here. The other classification that we would typically see under liabilities is a long-term or non-current liabilities. The fact that we don't have any listed here tells me that this company does not have any. Very unusual situation, of course. But if we had any long-term or non-current liabilities, you'd see a separate category here, a separate total, and then we'd add them together to get our total liabilities. Okay, again, I'm assuming if I don't hear or see any questions, I will assume everybody's good and we'll keep going. This is our final exercise in the set from chapter 4, and this gives us information for an income statement, and this income statement is based on the information given here. These are in from the adjusted trial balance for Shaw Messenger Service. So we'll start with our income statement. As always, we have a 3-line heading: name of the company, name of the financial statement, and the date or range of dates that it covers. So the balance sheet is the only one that has just a date. All of the other financial statements must say what the range is for. Is it for the year, the month, the quarter, the day, the week, whatever. So of course, we're going to start with our revenues. Fees earned, $875,000. And then we have all of these expenses. We know that the expenses should be listed in decreasing order from largest to smallest, with the exception of the miscellaneous, which we know is going to go last. So salaries is our largest value on there at 481.3. What's next? Looks like rent expense at 75,000. Followed by utilities at 40,850. And then depreciation, 14,500. Already got the miscellaneous of 10.2. So what do we have left? Supplies and insurance. So supplies is bigger. And we'll go ahead and add those expenses together. And if I did that correctly, I got $635,000. Since our expenses are less than the revenues, that would be a net income. Of course, if the expenses were higher than the revenues, that would be a net loss. And in this case, it would be a net income of $240,000. Okay, so that's the end of chapter 4. The focus in chapter 4 was on the idea of the classified balance sheet. We also looked at using financial statements to make decisions about a company. We talked about working capital and current ratio, are two measures that we covered in that chapter. And then we moved on to chapter 5, which was on the merchandising operations, accounting for companies that are selling product, but not product that they make themselves. So in this exercise, we're asked to calculate gross profit. I have always in class used interchangeably the term gross margin, and I suggested that gross margin is actually something that you would see much more regularly. Gross profit we typically reserve when we're not talking about the company as a whole, but we're talking about just maybe one product or one product line or one segment of the company. So I'm not sure why this book is very enamored of that term, and I'm not a big fan, but it's okay. It's not incorrect. And I just want you to be familiar also with the term gross margin, because that is a much more common term. That's likely what you will see on the financial statements for the company that you chose for your project. So gross margin or gross profit, the formula is very simple. It's sales minus cost of goods sold. Well, in this exercise, they tell us during the current year, merchandise is sold for $197.5 in cash and $391.4 on account. Both of those represent sales amounts. We do not need to know those separately. So they are providing both of those. We need to simply add those together. And our total revenues then would be $588,900. We subtract from that our cost of goods sold and get our gross profit of $176,700. So that was a quick and simple exercise just to remind you about the multi-step income statement and recognizing that gross margin is revenues minus cost of goods sold. Does not matter where those revenues come from. It doesn't matter if they're cash or on account. They all are included in this calculation. Also in chapter 5, we spent several exercises going over how to re-record purchases transactions, sales transactions. In chapter 5, we talked about perpetual versus periodic inventory systems, but we only did entries for companies that were using a perpetual inventory system. I did explain that the difference between the perpetual and periodic is how often we update that inventory account. The perpetual system updates it every time we have a purchase or a sale or a return, and the periodic system only gets updated periodically at the end of each period. And so in the entries, when we use a perpetual system, we debit to add to inventory, we credit to remove from inventory every time we have a purchase or a sale. And if we used a periodic system, we would actually use a whole separate set of accounts called merchandise purchases, merchandise returns, and allowances. So in this exercise, Bowers Company purchased merchandise on account from Saunders Corp for $5,000. So that's the amount of the merchandise. We did talk about payment terms, and here's one example of a very typical payment terms. We would read this 110 net 30 or 1% 10 net 30. What it means is if we pay within 10 days of the invoice date, we can take a 1% discount on the merchandise, not on any freight that might be applied. And if we do not pay within the 10 days, the full amount of the invoice, without discount is due within 30 days. Bowers returned merchandise with an invoice amount of $1,000 and received full credit. So they did owe $5,000. Now they only owe $4,000 because of that return. If they pay within the discount period, what is the amount of the cash required for the payment? So I'm just going to write this on the screen just to make sure it's clear. So we originally owed $5,000, but we returned $1,000. So now we only owe $4,000. And because we paid within the discount period, that is within the 10 days allowed within the payment terms, we are permitted to take a 1% discount. So we could calculate that 1% discount separately, but for the sake of expedience, I'm just going to multiply by 0.99 or 99% to find out how much we actually paid. We could multiply by 1% again to get the amount that we took as a discount, and then there'd be another step to subtract that discount amount. So when I multiply by 99%, I get $3,960. The discount then would be $40. We saved $40 by paying our invoice within that 10-day period. Remember, we would have had to pay the full thing in 30 days, the full invoice amount in 30 days if we didn't pay within the 10 days. So by paying, let's say 20 days early, we saved $40. That's a pretty significant savings. So question asks, what is the amount of cash required for the payment? That would be the $39.60. What account is debited by Bowers Company to record the return? So Bowers Company was the buyer. When they made the return, then they would be crediting merchandise inventory to reflect that they don't have that inventory anymore. And the debit would be to accounts payable. They no longer owe Saunders Corporation, so they want to get it out of that accounts payable so that it's not showing as a liability for them any longer. Again, feel free to jump in if you have questions. Otherwise, I'll just keep going. And now we have a sales transaction. So now we are going to be on the seller side of these transactions. Remember, when we use a perpetual inventory system, a sale, recording a sale is actually a two-part process. We have to record the revenue, and then we have to record the cost of goods sold. We're asked, it doesn't tell us which one to report first, but I'm going to assume they want the sale part first because of the way they normally do things in the software. My guess is they don't even give us the account titles we would need. They kind of steer us toward putting the sale or the revenue part first in that first entry. There's really not a wrong order to put them, but the software needs to have them in a certain order so it knows whether to mark things right or wrong. So it kind of steers us in that direction. This company sold merchandise on account for $11,900. The terms were net 30. So we're going to report that sale and receivable. Our customer, whoever it is, now owes us $11,900. And we report the revenue and we report the asset. Our customer owes us that amount. The second part, because they do use a perpetual inventory system, the second part is to report the cost of goods sold and to remove the cost of that sale from our inventory. We need to update the inventory to reflect we no longer have that merchandise that we just sold. If this company used a periodic inventory system, the first entry would look exactly the same, and they would not do the second entry because they don't update their inventory except at the end of the period. So now the company is going to receive payment. They weren't offering any kind of a discount. The payment was due within 30 days, and they weren't offering any kind of an incentive to pay early. So when they do pay, we're assuming that they paid the full amount that was due, $11,900. And that's the receivable right here. And because our customer paid us, they no longer owe us that amount. And so we're going to credit accounts receivable for that same amount. And so now our customer doesn't owe us anything, but our customer then returned some merchandise to us that it was defective. And so we talked about this in chapter 5, setting aside that liability that, hey, some of our customers might want to return merchandise to us. And so we're going to have, let's see, it's defective merchandise. And so we are going to pay our customer. We're going to refund the cash payment. If they had not already paid their bill here in Part B, we could just issue them a credit memo and reduce or credit accounts receivable. But because they already paid us, we're going to refund them in cash. We're going to credit cash for that. Remember, we had estimated up front that some of our customers might want a refund. And so we'd estimated this liability called customer refunds payable. And now that we are actually refunding them, we are going to reduce that remaining liability. So that customer refunds payable was an adjusting entry that we did to recognize when we recorded the sale. Hey, some of our customers, we don't know who, we don't know which merchandise is defective, or we wouldn't have paid it, or excuse me, we wouldn't have sold it. But we did know that somebody might return something. And so we estimated this liability, kind of set aside that value on our balance sheet. And now we're reducing that. Okay, let's keep going. This exercise, I really like this kind of exercise that has you play the part of both the buyer and the seller, so you can see how the two sides of the transaction, the two parties involved, would record the same events from different viewpoints. So in this exercise, Shore Company sold merchandise to Blue Star Company on account, $111,600. The terms were FOB shipping point. That's another concept we talked about in chapter 5. Really refers to, where does the title change hands? Where does it become the property of the buyer? And so if it's FOB shipping point, that means that it becomes the property of the buyer when it leaves the seller. The seller is the shipping point. And so in that case, the buyer who owns the product would be responsible for the freight charges as well. Tells us the cost of goods sold, tells us that the terms are net 30, so there's no discount involved here. It tells us that Shore paid the freight, but we said it's the buyer who owns the product while it's in transit. The buyer is Blue Star Company, so even though Shore paid that freight, Blue Star now owes that additional freight to Shore Company. So ultimately, it is Blue Star's responsibility to pay that because of the shipping, because of the FOB, the free on board, the freight terms. Shore Company issued a credit memo for $7,600 to Blue Star for merchandise that was returned. Cost of the merchandise was $4,500. Doesn't tell us the merchandise was defective, so we assume that it's going to go right back into inventory. And our first task here in these first few journal entries is to record Shore Company's sale, credit memo, and the payment. So we are the seller. As we saw in the previous exercise, the sale, to record the sale, is going to take 2 entries. We made the sale on credit, so we're going to debit accounts receivable and credit sales. The total amount of the sale, the amount that we charged Blue Star, is $111,600. And because we use a perpetual inventory system, we also need to report at the same time the cost of goods sold and remove that from our inventory. And it tells us here the cost of goods sold is $66,960. Oops. Then Shore Company issued a credit memo for $7,600 to Blue Star. So the And I'm just looking, they don't have, just looking to see if they had a separate line for the freight charges. So it's not uncommon for the freight charges to be a separate invoice because Shore probably had to wait till they got the bill from their freight company to know how much it would be. So it wouldn't be included here. We'll come back to that when we get to the payment. So for the credit memo, let's see, they issued a credit memo for $7,600. So they're going to they're going to remove that from what Blue Star owes them. They no longer owe them for that merchandise. And they're going to record this as a sale return and allowance to keep track of how much was returned to them. And so that's we haven't seen this yet, other than in this area. So that sales return and allowance is a contra revenue account. It goes against the revenue. And if because it has a debit balance, we would subtract that from our total revenues to get our net revenues or net sales. Because they use a perpetual inventory system, because it does not tell us that the merchandise was defective, then we can simply add that merchandise back into our oh, they don't want us to do it that way. So and they haven't paid us yet. We recorded that. I wonder if they just didn't label this correctly. If this is where they want I apologize. I obviously haven't done this exercise. I know what needs to happen, but I'm not sure in what order they want them. So we've got yeah. So sometimes it's a matter of trying to figure out what the software wants. So give me just a second. I'm going to go ahead to the next, the payment due, trying to figure out where they want us to put the freight bill, the 1,800. Again, I know what to do. I just don't know how they are asking to see it. So let's go ahead and show the receipt of the payment. Well, I guess I can't. Well, this is glad we're doing this one, because this is very interesting. I'm not sure exactly where they want the freight to show up. Okay, so I had to pause the video because I was really having trouble figuring out what they wanted. I know what the pieces all are, but honestly, the labeling they have over here in the left-hand side isn't correct. So the sale part was right, but then where I got stuck here, where it said credit memo, it wasn't actually the credit memo where that label was. And so that label should have been down one more line. So what we actually have here is the recording of that freight bill. Remember, it said that Blue Star, that Shore had paid the freight, but I explained why Blue Star actually owes the freight or is responsible for paying for it. And so when Shore paid the freight, they do this entry. They credit cash because they paid the bill, and they just add it to Blue Star's account. So that's not the credit memo, and that's where I got stuck. I couldn't figure out where they wanted me to enter that freight bill, and that's where it is. The next line, the next two entries actually are related to the credit memo and the return. So when they return the $7,600 that they were charged for the merchandise, Shore removes it, credits it to the accounts receivable, and debits it to that customer refunds payable that we talked about in the last exercise. But because they use a perpetual inventory system, they also are going to add it back to their inventory. And that's, again, where I was getting stuck because I wasn't finding any place that had an option for inventory being the debit, because it's by the line that says payment, but it's not actually the payment. That label also should be down one line. So this entry, adding the merchandise back to the inventory account and crediting it to the estimated returns inventory, that asset account, is the second part of that credit memo because they use a perpetual inventory system. And finally, the payment label should be down here. Blue Star is going to pay what they owe. And over here on the side, I have written on the screen how I determined how much they owed. The original purchase was $111,600 plus the freight minus the return. And that's why they paid $105,800. Now, hopefully, as we scroll down here, it's going to be a little bit more straightforward for the purchase side on Blue Star. So first, they're going to record that they bought the inventory, $111,600, and that they have to pay for it later. So we have an accounts payable to Shore Company. Then they had a return of there it is. They had a return of $7,600, and they're going to remove that from their inventory because they don't have it anymore. And now we're missing a little piece here because I don't know where they want the freight on this side. So we're going to check this in a moment. We already know how much the payment was. The payment, I still have that calculation on the screen. We know that the amount they paid was $105,800. But what I do not know is where they want the recording of the freight bill. So let's see. So must be they just want us adding the freight in as if we already knew, or they're summarizing that entry. And I'm not suggesting it would necessarily happen here, but they must be collapsing those two pieces together, both the freight bill and the purchase of the inventory. So it doesn't tell us to do that. That's not clear to me from the exercise. It absolutely could be a separate entry, just like it was up here for the seller. And so there's that exercise. I apologize that the labeling was misleading and it kind of threw me off. It took me a minute. I knew what had to happen. I just couldn't figure out where they wanted it. So I think we're good with that now. Clear my screen and we will keep going. So our next exercise, still from exercise 5, is some adjusting entries. And we talked a lot in class about inventory shrinkage and what that would mean, and that every company has to do a physical inventory at the end of the accounting period, and that amount would be audited. And so the auditors would be asking to verify that inventory. So this tells us that the inventory had a balance of $1,336,300, but when they took a physical inventory, counted what they actually had and assigned a value to it, they found out that they actually had only $1,300,400. And so the difference between those is $35,900. That $35,900 represents their inventory shrinkage. It wasn't recorded as cost of goods sold, but they don't still have it. And so it does need to be adjusted. This is an adjusting entry to correct the inventory to match what we actually have. So, whoops, sorry about that. I put it in the wrong spot. So because this represents inventory that we no longer have, we need to debit that to cost of goods sold and remove it from the inventory account. It tells us to assume any shrinkage is a normal amount, but we talked about in class what that might mean. Typically, our threshold in class for what is a material amount would be more than 5% of the total. But of course, each company can make a determination that they want to be more stringent than that, that they want to keep a tighter tolerance there and say maybe they're concerned if it's more than 2% or 3%. And that's going to be particularly important for companies that run on pretty narrow margins, such as a grocery store or Walmart. The second part B here, sales refunds and allowances of 243, merchandise returns of 60,590 are estimated for the current year's sales. And so in the previous two exercises, we've talked about both of these, that we need to estimate how much that might be and kind of set that amount aside on our balance sheet so that we're accurately expressing our financial position. That we think in this case we might have to accept refunds of 243.1, and so we're going to set that aside as an estimated customer refund payable, a liability to pay back those customers. We've already reported the revenues. Now we need to report that we might have to pay some of that back. Okay. And the other part, and I'm choosing sales there because there isn't a better option, such as sales returns and allowances. So I'm just going to choose sales there. And then the merchandise returns of 60,590, we're going to set that aside as the value of the merchandise we think is going to be returned. And so that's going to sit on our balance sheet as an asset to partially offset that customer refunds liability. And that's going to reduce our cost of goods sold, again, because there isn't a better account to use for that. So the impact of this would be, so you can see the big picture, the impact of this, think about, this is happening, we're making this recording at the end of the financial period. We're going to reduce our sales, we're debiting sales, so we're reducing our sales because we're recognizing, hey, you know what, some of the sales we recorded might actually get returned. And so we don't want to claim those sales if we think they're going to be returned. But at the same time, when those sales do get returned, we'll have the inventory back. And so we're estimating how much of the cost of goods sold we shouldn't be reporting as an expense to match against those revenues. Okay. Next, we have this is the last exercise from chapter 5, and this is the asset turnover ratio. So it's a measure of how good we are at using the assets we have to produce sales. So the formula that we had in chapter 5 is sales divided by average total assets. So we have a beginning and ending assets. We're going to average those together by adding them together and dividing by 2. That's going to be the numerator of our formula, and the denominator is going to be sales. So I'll write this on the screen just to make sure. I know I'm going pretty quickly, just to make sure this is clear. So for 2000, I'm just going to call it 23. We're going to take our sales of 1,738,000, and we're going to divide by the average of 730,000. Let me make my a little bigger here, plus 850,000 divided by 2. So you need to have both sets of parentheses there if you're plugging this into your calculator to make sure that the calculator follows standard order of operations. If you plug it in exactly the way I have written it there on the screen, it should work for you. If you don't have a calculator that will allow you to do that, what I would recommend is that you first calculate the average for the denominator, write that down, and then start a new equation. Start with your sales and divide by whatever that average is. And so when I plug that into my calculator, I got an asset turnover of 2.2 for 2023. Another way of thinking about that or interpreting that, we would read it 2.2 times. And what that means is that for every dollar we have in assets, we're generating $2.2 in sales, or $2.20 in sales. Can't know if that's good or bad. We need to have something to compare it to. We've talked about that several times already. And so for this problem, we're going to compare to the previous year. How are we doing compared to last year? Did we get better or did we deteriorate? Did we get worse? For asset turnover, the higher the number, the better. There, all my parentheses in there where I needed them. And so we can see that our sales went up from 2022 to 2023, but at the same time, we can see that our assets also went up pretty significantly. So we need to do this calculation to see, basically, did we use those extra assets we had to great advantage? Did we make good use of those assets and produce more sales with them? And if I plug that into my calculator correctly, then their asset turnover in the previous year was just 2 or 2.0. So higher is better. We generated an extra 20 cents per dollar in assets. And so that would be a favorable change. And so we're looking at sales from the income statement, assets on the balance sheet. Some of the calculations or ratios we look at will include just comparing one balance sheet category to another. Sometimes like this, we're comparing across financial statements. Okay. And let's keep going. So we're now moving into chapter 6. Chapter 6 is the inventory chapter. You can see that this question is a perpetual inventory question. We don't have the whole spreadsheet like we had in class that we were completing in our exercises. So, but this is a pretty simple scenario. We started with 76 units of inventory at the beginning of the month, and we sold 62. We're using a perpetual inventory system. So after that sale, what do we have left? I'm just going to put some notes over here on the screen. So we had 76 at 23. We sold 62. That means we have 14 left at $23. We then bought 54 more at $27. So we'll add those to our inventory. Whoops, not like that. 54 at $27. And then we sold 23. So now we have these two layers of inventory and we have to figure out which ones did we sell. So if we're using FIFO, that means first in, first out. The first thing we would sell is the $23 ones. And then we had 14 of those. So we would need 9 more from the $27 ones. So let me, now that I'm looking at what we actually need here, so inventory, and I'm going to go over here and put a column for our cost of goods sold, because I see that we need both of those. So on October 7th, when we sold the 62 units, we would move those 62 units at $23 over into the cost of goods sold, and we had 14 left in inventory. We added the 54 more. So when we sold on October 24th, we would sell the oldest units first, 14 at $23. And then we needed 9 more, I said, 9 more. And those would be from the more expensive $27 ones. And if we sold 9 out of the 54, we have 45 left at $27. So basically what I did here was set up a kind of a modified but simple spreadsheet, similar to what we had done in class. And now we can go ahead and answer these questions at the bottom. So our cost of goods sold would include the 62. I don't need to rewrite that, I don't think. We have it right here in the column, the 62 at $23 plus 14 at $23 plus 9 at $27. I'm just doing the what I call the extension, 62 times 23, 14 times 23, 9 times 27. And if I plug that in right, should be $1,991. And then our inventory at the end of the month is just what we have left, and that's 45 at 27 or $1,215. And I obviously didn't do the math right. Let me check my calculator. We sold 62 at 23, and then we sold 14 at 23. Oh, whoops, sorry. I need to read the whole problem. Cost of goods sold on October 24th, sorry. So that's only this part. I thought it was the cost of goods sold for the month. I hope you guys do a better job of reading the information than I sometimes do when I'm trying to do 3 things at once here. So we're just looking for this part, the cost of goods sold on October 24th. And what I put in was for the entire month. So let's try that again. I apologize. Trying to hurry. Please do not try to hurry on your exam. You'll end up doing the same thing that I just did. And that's bad. There we go. 565. So again, I apologize. I know we're going very long in this video and I'm trying to save you time, but still get everything in. Okay, so no questions. We'll keep going. Okay, now we have a similar exercise, and now we're using the LIFO method, but still the perpetual system. So I'll set up cost of goods sold. Let me pay attention to what we need here. Cost of goods sold on the 27th, and then our remaining inventory. So we had 82 units at $30. We sold 66, so those must be 66 at $30. Whoops, $30 because that's the only choice we have. And when we sell 66 of those 82, what does that leave us? I guess 16 at $30. Okay. Then we bought 91 more, so I'm just going to add those to our inventory record over here. 91 at $32. We're in a period of rising prices. We pointed that out before. And now we sell 76. We're using last in, first out. We now have 2 different layers of inventory here. And for last in, first out, we sell the most recently acquired ones. And so the 76 units we sold would be the $32 ones. And what we would have left would be all of the $30 ones still. And what is that? 15 left at $32. And so we're asked to find the cost of goods sold on July 27th. This time I read the whole thing. And so that's going to be this. Nope, that's our inventory. Sorry. Here's our cost. I switched the columns this time. So here's our cost of goods sold column. There's the July 27th sale. We would be selling 76 of the brand new ones at $32, total of $2,432. And our inventory on July 31st is what I have in the second box on the right. 16 times 30 plus 15 times 32, $960. Okay. So FIFO, last in, first out. We keep the oldest stuff, we sell the newest stuff. In a period of rising prices, the oldest stuff is, of course, the less expensive. And so our ending inventory has a lower value and our cost of goods sold is a higher cost compared to FIFO, which is the other extreme, highest ending inventory, lowest cost of goods sold, and weighted average cost is going to be somewhere in the middle. And now we come to weighted average. And so we're using a perpetual inventory system. And I'll go ahead and set up those same columns again and talk through. So let me be consistent. I'm going to put cost of goods sold first and inventory over here, just like I did in the last exercise, but not the one before it. So we have our inventory as of October 1st. On the 13th, we sell 150 units, and those all have a price of, use the @ symbol again, of $13. And so our inventory is now down to, 160 units at $13. And because we're going to need it here, I'm just going to go ahead and do the extension on that while I'm here. 160 times 13 is $2,080. On the 22nd, then we make another purchase. That's 340 units at $16. And I need to do the extension on that to find out our total. Remember, these formulas for calculating weighted average are right in Brightspace for you in the Chapter 6 reference materials folder. To find this new average after we make the purchase, then we're going to add to find our total cost of our inventory. And we're going to add to find the total units in our inventory. So the total cost would be 7,520, and the total units would be 500. And so just as the formula in Brightspace shows you, we take the total cost, 7,520, divide by the total units, 500, and it tells us to round to 2 decimal places. So that price, let me see if I can sneak it in here. Hopefully I can sneak it right in between those two numbers, would be $15.04 per unit after the October 22nd purchase. That's our answer here for letter A. Now, we didn't actually pay $15.04 for any of these units. We paid 13 or we paid 16. But as far as we're concerned, the assumption we make is that we paid $15.04 for all of them. So the key thing, the thing that's most likely to trip people up here is wanting to average just the prices, but it's a weighted average. So we need to recognize that we had almost twice, actually more than twice as many units at $16. And so the average is going to be closer to 16 than it is to the 13. Okay, so we had 500 units, we sold 200. And so those 200 that we sold on October 29th, 200 that we sold would be at that $15.04 per unit that we just calculated. That's going to be our cost of goods sold, and that's going to leave us with 300 units in ending inventory, again at $15.04. Okay. So let's see what else we need to answer. Assuming a perpetual inventory system, weighted average method, determine the cost of goods sold on October 29th. So October 29th, the sale is right here. 200 units at $15.04 would be $3,008. 200 units at $15.04, $3,008. And then determine the inventory on October 31st. We already know that's 300 units. That's right here, 300 units at $15.04 or 45 12. Oops, 45, 12. Okay. So we've now used all three methods, LIFO, FIFO, and average cost, on a perpetual inventory system. And let's see what else we have left here. Periodic system. Let's go through this quickly. Again, I'm very aware of the time here. So we're using a a periodic system in all three methods. We are given our beginning inventory, 2 purchases. We know we had 31 units available for sale, and we have 19 left at the end of the month. So if we had 31 available and we sold 19, we have 19 left, we must have sold 12. What we are asked to calculate here is the inventory cost. It also would be reasonable for us to ask for the cost of goods sold, not just the ending inventory. But our job for this exercise is to find the value of that ending inventory. I'm going to give myself a little bit more room here to write. So we have 19 units, as it says right here. In the ending inventory, the question is, based on the assumption of LIFO, FIFO, or average cost, which 19 units do we have left? So for FIFO, first in, first out, we would have sold the 14 units. We have 19 left, I'm sorry. So we would have, let's identify those 19 units. That'll make it easier. So we're going to keep all 9 of these, the newest units we have. We're going to keep these 8, and that will bring us up to 17. And then we will keep just 2 of those 14 units. So we sold 12 from that beginning inventory. So to find our ending inventory, it will be 9 at $45 plus 8 at $44 plus just 2 at $42. So we can see that we're in a period of rising prices again, and we're under FIFO. We're going to keep the newest and therefore highest value items. And I got $841 there. Now for the LIFO, let me clear those drawings. For the LIFO, what are we going to keep? Well, we need last in, first out. We sell the newest ones and we keep the oldest ones. So we would keep these 14, and then we would, out of this 8, how many more do we need to get up to the 19 total? We would need 5 more. So we would keep 14 at $42 plus 5 at $44, and our ending inventory would then be $808. We already know from what we discussed in class during chapter 6 that in a period of rising prices, LIFO has the lowest ending inventory, FIFO has the highest. Weighted average is going to be somewhere in the middle. We do still have to calculate that weighted average though, and we already went over this formula. $1,345 is the total cost. We have 31 units available. And so I'm finding the average of each one of those, the average cost of each one of those 31 units, rounding to 2 decimal places, $43 and rounding off 39 cents. And we had 19 units. So 43.39 times 19 is 8. And then we're asked to round the final answer to the nearest whole dollar. So that would be $824.41, rounded off to $824. So one more point about using the periodic system. It doesn't matter the order. It doesn't matter when the sale took place. We know we sold 12 units, but it doesn't matter whether we sold them after the first of January before we made a purchase, or after that purchase in August, or after that purchase in November. In the perpetual system, it does matter. We have to do things in chronological order from start to finish. But under the periodic system, we're standing at the end of the year. We have all the information in front of us. We average all of the costs together rather than calculating after each purchase and after each sale. Okay, one more exercise. And thank you for sticking with us. So here we have inventory turnover and number of days sales in inventory. So I showed you the formulas that the book used, and then I told you a little bit easier way to approach this. So inventory turnover, the calculation is cost of goods sold divided by average inventory. So for 2017, we'll call that, we take our cost of goods sold, 3,498,525, and we're going to divide by the average inventory. Okay, so there's our calculation for 2017. Apologize for my puppy. And it asks us to round to one decimal place. So for 2017, I got an inventory turnover of 4.5. And then we're going to do that same calculation for 2016. So average inventory in the denominator. Stretch that out a little bit. Whoops. Oh, sorry, didn't get it stretched out. So you can see that calculation though. Cost of goods sold in the numerator divided by average inventory in the denominator. And for 2016, I got an inventory of 5.1. Contrast that with the 4.5 of 2017, and we would say that the company isn't selling through their inventory as quickly in 2017. I'm going to go down here and answer part C. That change is unfavorable. They're sitting on their inventory more for a longer period of time. Their inventory carrying costs are then going up, and that is not a good thing. I told you in class a simpler way to calculate number of days sales in inventory, since we already know the inventory turnover, unlike the more complicated formula the book gives you. I would simply take the number of days in the year, 365, and divide by the inventory turnover. So and round to one decimal place, it tells us. So for 2017, 365 divided by 4.5 is 81.1. And so they're taking about 81 days to sell their inventory on average. And in 2016, 365 divided by 5.1. In 2016, they were selling it about 10 days faster. And so that means 10 days less in their financing period, in their operating cycle, 10 days faster they're getting their money from their customers because they're selling that inventory and getting paid for it. They then have that money to turn around and reinvest in the business to buy more inventory or whatever it is they need to do. Again, that's our last exercise. Thank you very much for sticking it out with us. I know this was a long session. If you do have any more questions, anything else I can help with as you're preparing for the exam this weekend, please do let me know. Again, thank you for being here.